Now here we're going to turn to Europe, and we have some good charts to show. Unfortunately, I don't have my Bloomberg right now, so I don't have the ability to do the summary backdrops, but I think there's a lot of things that we can cover. So the Eurozone credit impulse, for things that we've seen, the credit impulse, when you look at the different levels, deposit adjusted credit impulses continues to go negative. But when we look at what the ECB has done, they've taken rates from 3.75% to 4%. And when you look at the other level, the refinancing operations, they went from 4.25% to 4.5%. So again, you're seeing that movement back up, but now they're saying that they can stop, and I think it's going to be difficult to say that, given that you're getting actually a reacceleration again in inflation, not just in the U.S. but also within Europe. So here you can see that increase in general. But then when you look at the movement of money, the Eurozone credit impulse breakdown, NFC, households, it's all moving lower, which is what they want to see. Now they issued negative bonds for a very long time, and at some point we've been saying that comes back to haunt you. I don't know why. I get it. It sounds like a good idea while it's happening, but at some point that comes full circle. And here is that full circle that we've been talking about. The economic forecast for the summer of 2023, Germany is now negative for 2023, while others remain positive. For those that have been following us, we think that there's a full recession that is going to happen within the Eurozone. Eurozone bank lending to households is steeply negative, and we don't see that getting better. Then it's a mixture of why. Not only do banks not want to lend, but people don't want to borrow. And I think there's two sides to this, which sometimes people miss the bigger theme of it, where that's going to be, I think, an overarching problem. Now, economists expect no GDP growth in Germany over the rest of 2023. We obviously think that it's going to be negative. According to Goldman Sachs, Germany is in a recession. We agree with that. Goldman expects German GDP to contract by 0.6% in Q3 and 0.1% in Q4. I think it would probably be greater than 0.1, and likely 0.6 is something that we agree with on Q3. We just don't think there's going to be a bounce, especially as inflation is picking back up. And then in Q4, but they see an acceleration to growth in 2024 of 1%. Again, that is not something that we're seeing. Could it be negative in 2024? I'd say that it's likely. It's not going to be negative 2%, but negative 0.5 to negative 0.2, sure. Especially when you look at who their trading partners are, what the problems exist and how they exist, and the fact that the ECB is not going to be able to lower rates. You're not going to get that monetary support, let alone fiscal support at this point. ECB considering lifting rates to record highs. Again, by Reuters, the European Central Bank is set to decide on Thursday, which we talked about. They did raise rates. So when you look at some of the positioning right now, it's at an elevated level, and it's going to stay at that elevated level. Eurozone industrial production, excluding construction, again, continuing to roll down. Eurozone, when we look at the industrial production side and some of the key pieces, it continues to turn negative. Here's where you look at 105.2, but then manufacturing production, again, moving in the negative direction, which we do think goes into contraction over the next few months. But core inflation has fallen more quickly in the U.S. So the Eurozone is sitting up here. Now, we had a reacceleration in PPI. We've had a reacceleration in CPI. Europe had the same thing, and now it's going higher once again. And labor costs are rising at a rapid rate in the Eurozone. So how can the ECB cut rates if the two key areas that they're looking at are telling them not to? Yes, is there a recession? Are there problems there? But there's too much liquidity at this point that they're going to have to get in front of it. And again, as we've said, when you issue negative debt for so long, there are ramifications. German factory orders month on month came in at negative 11.7. Factory orders, as you look at it on two different levels, 96.2. So again, you're not seeing growth. And that's why I think the acceleration in Q4 for growth, and again, Goldman Sachs is saying that Germany is going to be below growth and in recession Q3, Q4. I just don't think they're going to get a meaningful bounce from Q3 to Q4 like they've been talking about. Construction PMI at 41.5, again, flatlining. Housing activity at 30, which now, mind you, 50 is things are the same. And anything above that is expansion. Anything below that is contraction. 30 is bad, very bad. I mean, that's not something, and I'm not laughing because it's funny. I'm laughing because that is an insanely low number in terms of activity. Eurozone retail sales, the volume is flatlined. You can see it's obviously fallen away from trend, and it continues to pivot to the sideways level. Euro area consumers have stayed very cautious. Extra spending money has come down. Household savings have come up. But that's what we've been saying is they're reducing spending, saving more, but they're not looking to leverage that. There's no new loans. There's no new, and that's, I think, a key component that we're seeing of this shift in terms of the consumer. And it's actually resembling something similar to Asia. And that's where we're going to get a bigger slowdown. And at some point, I don't know, it's going to be difficult to say when, the U.S. consumer is going to do something similar. And that's going to have a much bigger impact on our economy because the consumer does more in the U.S. than it does in the other two. When we're saying Europe and Asia. German assessment of current situation, it was expected at negative 75.5, came at negative 79.4. Expectation of economic growth expected at negative 15, came in at negative 11.4. So again, you're still seeing that meaningful slowdown. German manufacturing PMI output index shifting lower, which again is going to pull down that industrial production side. Manufacturing sentiment and investment continuing to move into negative territory. When you look at the leading 3 months, that's why this is going to be that next shoe to drop on the manufacturing sentiment and investment. And for the Eurozone relies more on manufacturing than the U.S. Its services is still over 50%, but there's a huge amount of exports that happens in this part of the world. And the fact that they're not going to be able to do it to the same level, especially because they've relied so much on China, and as China slows, those headwinds will continue to mount. Conditions have deteriorated rapidly in German construction, lack of orders, project cancellations. And I think this is showing just how quickly the pivot can come. And we saw it in 2008 in the US, and you're seeing it here in something similar, not to this degree, because a lot of these are adjusted rate mortgages, which is a much bigger issue when you look at it. And I actually have a good quote from that, which I will get in a minute while we go through the charts, because then when you look at some of the pipeline pieces, here it is. 20% of residential mortgage borrowers representing $130 billion in loans, and this is in Canada, at 3 major banks, BMO, TD, CIBC in Canada, are seeing their balances grow as monthly payments no longer cover all the interest they owe, known as negative amortization. This is what happens with ARM loans or ARM mortgages. Now, this is an area in Europe, they have a lot of them. And so the pipeline of new German construction projects has dried up because people are like, look, new rates, I can't afford it. It's got to stop. Which is why you have lack of new orders and then project cancellations, because it's like, look, I was going to do it, I can't get financing, or the financing dried up, or I couldn't post a collateral, and that's something that continues to hit in general. So then when we turn to non-financial corporate net interest payments, local in the U.S., that's come down. In the European area, it's gone back up. Average MFI interest rate to non-financial corporations continues to surge higher. And again, that'll put more and more pressure on the underlying European economy. So that's what we have for you for Europe. In the next segment, we're going to go deeper into Asia with, again, that focus on the Chinese stimulus and what we expect to happen next.